dividends, cash flows, and dividends. The magic formula for winning the earnings season, your roadmap for big oil and E&Ps. PG&E's recovery in jeopardy. Deadly fires in California and days of blackouts put bankruptcy plans for the utility at risk. Europe's Green New Deal. We speak to Franz Timmermans, incoming Executive Vice President designate of the EC. He will be responsible for delivering on Europe's ambitious climate plans. I'm Alix Steele. Welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, we want to kick it off with Spot On. It's our analyst and investor take on the big story. Joining me is James West, Senior Managing Director of Oilfield Services at Evercore ISI, and Dan Dicker, the author of Shale Boom. And our spotlight is on U.S. E&Ps and big oil earnings. So BP reported profit that beat estimates. Then the stock gets hit when the CFO, Brian Shalvari, says it was premature to raise the dividend now. This forced the company to release an official statement Wednesday saying, quote, BP wishes to confirm that no decision has yet been made with respect to the Q4 2019 or any future dividend. Okay, James, you're the analyst. What did you make of this when that happened?
Well, I think it's unclear about their cash flows in the back half of this year. Instead of wanting to get in front of themselves and raise the dividend, I think it's
which makes sense.
That. Right, sure.
But the market was like, we don't want to own you. If you're not even going to commit to something nice, we don't like it. What is that?
Well, the market doesn't like anything in energy right now, so it's not uncommon for energy stocks to go down on somewhat no news. And so I think the market, with the big oils in particular, likes those dividend yields and wants to know they're going to have that dividend in the future.
And we saw the same thing with Shell. That came out on Thursday. They didn't really commit to the dividend in that one. It's the same thing kind of happened. Dan, do you need to see a juicy dividend to want to own
Absolutely,
oil?
But I think that the majors have structured themselves so that the dividend is really what they have over everybody else in the patch. They're going to protect that as much as they can. So a dividend increase, that may not happen, but in terms of retaining what they have so far, I think that's primary for all of them. The first time one of them even breathes that they're going to deal with a cut or try to cut, that's going to be a real problem for the rest of the sector.
So what I'm trying to get my mind around, though, is at some point, something's got to give, right? You prioritize cash flow and you want dividends, but at some point you're also going to have to grow. And this really swirled around Continental when they reported. They wound up cutting their rigs so much. Now the question becomes, what happens next year when they run out of their drilled but uncompleted wells? Dan, how do you see it for the smaller E&Ps?
I think this is absolutely, in many ways, this is what has to happen. And in some ways, this is very good for the industry that they're finally going to have to cut back in terms of the amount that they're pumping, because rigs have dropped just enormously, down 240 over the course of the last year, and yet the amount that's coming out of the United States isn't really dropping all that much, and that's really been what's impacted prices and kept it in the 50s. It's a horror for the industry. It won't change until that turns around. So this is actually a good thing. It's going to cause some more pain first. That seems clear, but in the end, it's going to be good.
James?
We absolutely agree with that. We think capital constraint is first and foremost the biggest priority for the industry right now. Not only the E&Ps, but also the service companies. We've got to get back to generating returns, generating real cash flow, and giving some of that cash flow back to shareholders.
So I want to highlight a note that you had out in early October, which caught my eye. It says the oil shale revolution is over, finally. Investors are damn near catatonic. E&Ps have no viable options except M&A, and oilfield services companies are running away as fast as they can. Dan, you're nodding. So James,
smart guys at Evercore.
So over means like what? We're not pumping anything? Like no more production? What does that mean?
We were a little spicy on saying the shale revolution is over. The shale's going to be here, but we've invested over $1 trillion in U.S. oil shale over the last decade. We've gotten $700 billion back in cash flow. So that's a negative 38% cash on cash return. That doesn't work. So revolution is not something we want to call this. The only person that's actually done well in this scenario is the consumer. It's not the oil companies, it's not the investors, and so something needs to change. We need to generate profits, need to generate returns for shareholders, and quite frankly, growth is not how you generate total shareholder returns. There's really a linkage better to return on capital invested.
So, Dan, do you play that then? Like, do you play the M&A or do you stay out?
I think you stay out. I think right now all of the high beta shale players are a no-go, and I've said that since early in the spring, and I don't think there's any place in the sector right now that you can be in terms of the independent shale players. There's not one that I particularly like at all.
So if you take a look at, say, the E&Ps versus integrated versus the oil price, integrateds have actually been able to outperform the oil price, probably in part because of the dividends, and they have all the money. At what point, like, so what makes E&Ps perform well again? Like, do you need the $70 oil price, or do you need the M&A? Do you need production to slow? You need weak productivity? What do you guys think? James?
I think it's a combination of all those. I think productivity needs to slow. I think growth needs to slow down as well. And I think real cash flow generation needs to happen for the E&Ps. I think for the service companies, it's a bit different here. I've got really a market of 4 twos, if you will. Too many management teams, too many companies, too many assets, and too much debt. I've got to consolidate.
So give me a contrarian play here, Dan. You guys are really bumming me out. Like,
Well,
if I was a shell company.
I mean, it's been obviously a horrible sector to be in for the last year. I mean, it's really hard to find something that isn't scary. See what I did there?
Yeah, you did. Yeah.
But I have one contrarian play for you if you like it. I mean, there's a point at which, I mean, day rates have gone up tremendously offshore, and there is utilization at numbers that we haven't seen in about 3 or 4 years. Now, it's all short-term contracts right now. There's absolutely nothing on the long term, but that seems to have to change. I think companies, like Rig, they're down at $4.50. I don't think it can go much lower. So if you're looking for something over the course of the next 2 years that might give you some serious payback, I would say offshore. It's time to maybe do a little bottom fishing there.
So Transocean there. James?
We love Transocean, and we didn't talk before, I promise. So Transocean and Valaris, our favorite offshore drillers. We also like the large diversified service companies, so Baker Hughes and Schlumberger.
All right, guys, thanks a lot. Really appreciate it. James West of Evercore ISI and Dan Dicker, author of Shale Boom. And as we head to break, it was kind of an odd statement from Nigeria's Minister of State for Petroleum Resources. He told Bloomberg that the Saudis are ready to do deeper oil cuts if necessary.
There's a willingness to cut if the need arose. If we go to Vienna in December and there is a definite need to cut, we are ready to go deeper.
I'm Alix. This is Bloomberg Commodities Edge. Time now for the data dig. We're going to delve deep into the market trends of the week. First up, oil inventory numbers. We saw a surprise build of almost 6 million barrels. Cushing in particular actually rose for 4 straight weeks. Should point out the U.S. is now back to being a net importer. And U.S. farm bankruptcies in September surged 24%, at the highest since 2011. So this map shows Chapter 12 bankruptcies by state. The more orange, the more worse it is. They had 580 so far. Almost 40% of projected farm profit this year actually is going to come from trade aid. And check out this price collapse. So these are natural gas Permian prices known as Waha. There is a delay in a key Permian Basin natural gas pipeline that sent these prices plunging. Will they recover? That's the question. All right, now let's dig even deeper into the tanker market. Rates for moving crude around the world hit sky-high levels in the past few weeks. That enticed tankers to stay at sea instead of putting in exhaust gas scrubbers. Bloomberg BNEF found new order growth for these scrubbers fell to almost zero, and they're needed before January 1st to comply with new sulfur emissions rules. So earlier I caught up with Dwight Anderson, founder of Osprey Management, and I asked him what his IMO 2020 trade is.
We just generally like both heat and diesel against either gasoline or as form of a crack for, let's say, March of next year, in that people got into this way too early, okay, a year ago, and commodity markets are more coincident than leading. And so they gave up on them in the second quarter. And so that gave you some great entry points in terms of diesel cracks and also diesel versus heat. And both of those are diesel versus gasoline. And so both of those we think are pretty compelling even here.
That was Dwight Anderson, founder of Osprey Management. All right, now let's get into the ring. Fires roaring across California. Officials are looking into the cause. Now, we do know that a jumper cable connecting PG&E equipment to a transmission tower near Kincaid Road failed just minutes before the fire began. It's just more bad news for PG&E, which has been responsible for at least 17 of the state's 21 major wildfires in 2017. Bloomberg's Lynn Doan has been following the story closely for us from San Francisco. Lynn, give us perspective as to just how bad this winds up being for PG&E and what it means for their bankruptcy.
Thanks for having me, Alix. That's a good question. I mean, the wildfires that are raging now are inextricably linked to the PG&E bankruptcy case, right? So PG&E has already been held liable for some massive wildfires that broke out in 2017 and 2018, including the Camp Fire, which was the deadliest fire in California history. From those fires, it's facing about $30 billion in estimated liabilities, and they're trying to come up with a restructuring plan to deal with that $30 billion and figure out how to cover it. Now, if this Kincaid fire does end up being PG&E's fault, that is a whole other fire that would take precedence over all of those others. And if it destroys 500 structures or more, it ends up triggering a clause within PG&E's restructuring plan that allows all of the financial backers that have agreed to that plan to go back and renegotiate all of the terms and withdraw from that plan. So it could really delay PG&E's efforts in emerging from bankruptcy by early next year.
So how does this ever get fixed? Because wildfires aren't going to stop. And even if they continue to do blackouts to prevent a wildfire from happening, it's not going to work. So how does this ever resolve itself?
Right, and trust me, as somebody who has seen her power cut twice during these blackouts, that's the question that's on my mind too. And what PG&E CEO has said over and over and over again now is that it will take 10 years before the company can really fireproof its grid to the point where it can ratchet down these blackouts. Now, California Governor Gavin Newsom has said that 10 years is unacceptable, and he's not willing to wait for California to get to the point where the grid is fireproof for 10 years. And they're trying to come up with solutions now. A few fixes that have been thrown out there, solar, batteries, more backup power generators, accelerating inspections, doing more tree maintenance. It remains to be seen whether any of these are fixes that can get us to a point where the blackouts and the wildfires actually end.
In the meantime, where does this leave, say, the investors who are still in the equity, who are still in the debt?
Right, and trust me that they are watching that number of structures, the number of structures that the Kincaid fire is damaging and destroying very closely to see whether that 500 structure number actually gets exceeded during this wildfire season. A lot hinges on that. A lot hinges on how much damage this fire actually ends up causing, and nobody can say that right now because the fire is still raging. A lot of it is contained, but it has yet to be extinguished. And meanwhile, there's a whole other set of fires that PG&E is being investigated for starting potentially. So we will have to tally those losses once this event is actually over.
Lynn, really appreciate you catching up with us. Bloomberg's Lynn Doan joining us there. And it's time now for our note of the week, and it comes to us from the World Bank, which is downgrading its global commodity forecast. They write, expectations for global growth both for 2019 and 2020 have been revised down substantially, including in emerging market economies. Since these economies tend to have a larger income elasticity of demand for commodities than advanced economies, their slowdown has weighed disproportionately on energy demand. The bank, for example, says crude is going to average $60 this year and only $58 in 2020. Well, coming up, Frans Timmermans, EU Executive VP for the Green New Deal, will discuss Europe's ambitious goal of zero net emissions. That's coming up next on Bloomberg Commodities Edge. I'm Alix Steele. This is Bloomberg Commodities Edge. Time now for the BNF Brief, which gives in-depth analysis on clean energy, advanced transport, commodities, and emerging technologies. Today we're going to focus on the big car deal of the week. Fiat Chrysler and Peugeot owner PSA will merge to create a $48 billion company. A big part of that deal is to find scale and money to make the transition to electric vehicles. Joining me now with more insight is Colin McCarricker of Bloomberg NEF. He joins us from London. Colin, walk us through kind of the idea of how much money these companies are going to have to put into the EV landmark, and why do they need each other?
Yeah, I mean, both of these companies have actually been laggards so far in electric vehicles. So they're certainly behind groups like Volkswagen or Nissan or, of course, Tesla. But what you've seen from both of them in the last few years is really in the last year that they've announced a really big upcoming push, spending several billions of dollars. So PSA has said, look, we're going to launch 15 new EVs, or a total of 15 EVs by 2021. FCA saying 32 different EVs by 2022. That's going to cost a lot of money. So I think that's part of the motivation for this deal, definitely.
So what does it wind up meaning for the pace at which they can do this? Because if you take a look at, say, EVs as a percentage of sales, it's still the Chinese companies like Geely, BYD that are just crushing it. How do they compete?
It's still going to take some time, but one of the things you have is that in Europe, the CO2 regulations are really forcing automakers into this. So they have to start selling EVs next year, otherwise they're going to start facing fines. So what you're about to see is actually a big push from pretty much all the European automakers. Anybody who's selling EVs in Europe are really trying to up those numbers in the next few years. So you're going to see that from PSA. They've got a couple models coming out next year. You're also going to see that from FCA. The FCA is a bit further behind, and that's actually why they've had this tie-up with Tesla to try and improve their overall CO2 emissions and reduce the fines they might face otherwise.
Colin, thank you so much. Really appreciate it. Bloomberg's Colin McCarricker joining us from Bloomberg NEF. We turn now to Commodity in Chief, where we focus on one executive in the commodity world. Today, it's Frans Timmermans, the Executive Vice President for the European Green Deal Commission. First, a closer look at Europe's climate goals. The EU has big goals. Be climate neutral by 2050, reduce greenhouse gas emissions by 80 to 90%, and get a third of its energy from renewables. And all of that costs money. Even if all the states deliver on their plans, which many are behind in, it will still take as much as 575 billion euros a year for 2 decades to reach their target. It's also a big ask for some pro-green companies like Germany. They're deficit scared and are committed to balancing the budget. Now, all of this falls on the shoulders of Frans Timmermans, the incoming executive VP for the Green New Deal. His job is to formalize this plan for the EU to become carbon neutral by 2050, extend the EU emissions trading system, which lets the market trade allowances for emissions, and consider a carbon tax on all imports so companies can't relocate to countries with easier climate rules. And that's just the beginning. One option is to turn the European Investment Bank into a climate bank to unlock $1.12 trillion, all needed to entice private companies to spend their own capital. It's big changes, big goals, big money, and a big distance to success. I recently caught up with Frans and asked about some of these big climate goals.
How we build houses, how we refurbish houses, what we do in our transport sector, what we do in agriculture, what we do in fisheries, what we do in the maritime sector, the airlines. So you need to sort of refocus your attention on all the issues that have an impact on your climate. And that's what we're going to do. And we want to do it in the first 100 days of the next commission, starting on the 1st of November, so that we have our climate law ready very soon, and then we can follow up with all the legislative measures we need to take.
So do you need incentives or disincentives? What works best?
I think both. We need both. We need to make sure that fossil fuels become more expensive. Already now, you know, wind energy in the north of Europe, solar energy in the south is cheaper than fossil fuels, so that's sort of paying for itself. But we also need to give countries an incentive to wean themselves of coal. And to do that, we need to invest in the new economy. We need to give them an alternative. Just saying to coal miners, we don't need you anymore, is degrading, and they will say they will resist, and their governments will support them. But to say to them, we need you, but in a different place with a different job, and we will give you the money to be trained for that job, is a proposition I think that could be attractive.
So if you were to rank like the 1, 2, 3 most realistic and most important incentives and disincentives, whether it's a carbon tax, whether it's a tax on flying, whether it's a tax on internal combustion cars, whether it's job retraining program, can you help me understand which it is?
Yes. I think, first of all, we have an emissions trading system that is becoming more and more successful. So carbon is already priced, but it's only limited to a certain part of our industry. We need to expand that. We need to also include shipping in that. We need to include the airlines in that, either through this emissions trading system or through taxation on kerosene, which is not being done right now. We also, and secondly, we need to increase the speed with which we get rid of the carbon fuels in our energy mix. We can do that well. Some of it is paying for itself, but we need to create the right grids. Investing in grids is going to be extremely important to help countries to do that. We need to create pan-European interests. We need to make sure that one country can help the other. We need to also invest in the hydrogen economy. I would be a big fan of doing that because, you know, on batteries, Asia is way ahead. On hydrogen, Europe can still lead the world.
Who's going to finance it? Does it need to be, what part of it needs to be public? What part of it needs to come from private?
That's a crucial question. I think I can't give you a percentage. A lot of it will have to be public through a tax shift. for instance, but much of it can be private as well, because the one thing I've learned over the last couple of years, industry is changing its focus. It understands more and more that it needs to invest in this. Again, we have very low interest rates. We have banks telling us, give us good projects because the money sitting in the bank is not making any money. So, the conditions are really quite good also for the private sector to be part of this. We have an investment fund in Europe, the so-called Juncker Fund, that over the last years has been extremely successful, especially in helping local entrepreneurs, the local economy to flourish. And this has led to a huge amount of extra jobs. Now we need to green that sort of investment to make sure that we focus on investment that helps us make this transition.
Do you feel like there is the stomach for companies to, say, issue more debt or issue equity in the market to put money into these kind of plans?
I think there is. I think this is what I'm seeing. Many CEOs approaching me now in my new capacity as the one who's going to have to bring this Green Deal together, saying we want to be part of this. We understand that is the future. We want to attract the best talent in Europe, and we can only do that if we are a clean company.
When do you think a deal on zero emissions by 2050 can be reached?
Well, I hope that we can put the plans into place in the first 100 days. This is my job in the European Commission. Then we have to take it to the European Parliament. There's a lot of support in the European Parliament, but then we'll have to take it to the member states. And it will depend on whether those member states who know that they have a huge, huge effort to take, whether they believe that we will support them enough in that transition. So I want to have credible plans coming out of the Just Transition Fund to help those countries make that transition in a socially acceptable way.
That was my interview with the EU's Frans Timmermans. Well, Brexit meltdowns aren't just limited to parliamentary sessions. Oh no, the British government is scrapping its plans for a commemorative Brexit coin to mark the date of the UK leaving the European Union, which Boris Johnson swore would be October 31st. Now those coins have to be melted down. The limited edition commemorative Brexit coin was first announced back in 2018. Another currency battered by Brexit angst, the pound. All right, here's what's on my commodity radar for next week. Monday, we start to get the big guys from the E&P sector, Occidental plus Pioneer Natural Resources. Occidental key in how they're merging with Anadarko is going. Wednesday, we get earnings from Barrick Gold, what they're doing with the gold price, how they're going to be investing, particularly any plans they have in Africa. And then Friday, we get the WASDE report. It's the World Agricultural Supply and Demand Report. Trade key, China key, how much are they buying from Brazil, how much might they be buying from the U.S. That wraps it up here for Bloomberg Commodities Edge. Check us each week at Thursday at 1 p.m. New York time. This is Bloomberg.